Hey everybody, Brian Shannon here. It is Tuesday, June 22nd, 2010. Let's take a quick look at this S&P 500. As we know, the market has just broken down below the 200-day moving average. And that 200-day moving average was important as well because it was the area of that bigger level of prior support that had become resistance, and then all last week we saw that 111 was also an area of support. So yesterday we were looking for the market maybe to bounce a little bit from that area up towards that 5-day moving average, which was we were looking for it to flatten out and start to decline, and then break below that 111 level to set us up for a move down towards 109. Now, on the right-hand side of this chart, you can see this volume volume by price rather, which shows the heavy amount of trading that's occurred. In this case, over the last 10 days, we had seen some of the heaviest volume up in this area as the market went sideways. So what does that mean? It means that the market has trapped a large group of participants by that average person who basically participated. The biggest level of commitment to this market was in this range of basically 111.30 up to 112, 112.10. So when the market breaks below there, all those people are trapped and they're in a losing position. So today what happened was actually pretty classic, the way it rallied up to that 5-day moving average. And that 5-day moving average was also pretty much nailed the daily pivot level. We had seen another attempt for a push higher, and then in the afternoon, that's when we really broke that 111 convincingly, and then the floodgates opened right down to the daily S2 level. So this market is correcting right now, and that S2 level was also an area of importance from this prior resistance back on June 11th that had become support here on June 15th. So we see this market is behaving very well on a technical basis, and if you look at the 65-minute time frame, we're really coming into an area that's seen the heaviest amount of trading since back in April, mid-April that is, since this market really kind of peaked out, that we've seen the heaviest level of volume, or where the market has the most price memory, is right down between about 108.50 and 109. So that should be a level of support. Doesn't mean it will, but that's where you would expect to find support for this market. If we take a look at it a little bit differently as well, we could say since the flash crash lows, for instance, the volume weighted average price, the average participant is now losing money after today's loss. If we take a look at since the low was made here on the 25th, the volume weighted average price is just below us right here at about 109.12. If we look at, as I did intraday today, since the recent low, then we're right in that area. So we're in this important area, which is also, as we can see here on the daily time frame, where we have that 20-day moving average. So I think that we're likely to see this market begin to try to stabilize. Maybe we'll see a little bit further weakness, although the futures are up a little bit right now. But perhaps tomorrow we see a little bit further weakness down towards the low end of that range, maybe down towards that 108.75 type area. But I would expect that we're likely to find support in there, and then we kind of need to let the market give us some more information before we can really determine where the next short-term movement is going to come from. So I wouldn't be expecting a whole lot, and we have the Federal Reserve meeting as well. So anyways, it looks like the nice easy move was made here this afternoon. That's what I was talking about yesterday. Hopefully you guys participated.